The game is up. Major changes are rippling through the property market with continued pressure on many households. So, we examine the latest data. Welcome to the Property Imperative Weekly to the 13th of January 2018. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's review of the latest finance and property news, we start with the AFG Mortgage Index, with data to December 2017. Whilst the view is myopic as it's only their data, it is really useful and highlights some of the transitions that are underway in the industry. First, there's been an astonishing drop in the number of interest-only loans being written, from 60% of volume in 2015 down to 20% now. Wow, that is a change. We also see a small rise in first-time buyer volumes as expected. So the regulatory intervention is having some impact. However, average loan sizes are rising and faster than income and inflation. And Victoria stands out as the state to watch, with an increase in the average loan size over the past 12 months nearly double the size of the increase in New South Wales. So more, we think, still needs to be done on the regulatory front. Overall, the average national loan size is up 2.8% over the past 12 months. That's more than inflation. The average loan size in New South Wales is now over $613,000. Queensland's increased by 3.4% to around $416,000. South Australia is up 3.4% to $390,000. The Northern Territory up 22% to $469,000, albeit from a low volume. Reflecting the challenges being encountered by the Western Australian economy, the state's average loan size is down 1.1% to $439,000. Finally, the share of the major banks is falling, as we've seen from other data, as smaller players and non-banks pick up the slack. The majors now have just 64.2% of the market compared to the non-majors' 35.8%. There is more evidence of poor mortgage lending practice, according to online property lender TikTok Home Loans, as reported in the Australian Financial Review. This is another version of the liar loan story and shows that borrowers are more stretched than some lenders suspect. TikTok says 1 in 5 property borrowers are exaggerating their income and nearly half are understating their spending. And this triggers new concerns about underwriting standards and the potential vulnerability to sharp economic conditions. We have seen similar issues in our own surveys as households stretch to get the largest mortgage they can, whatever the cost and whatever the risk. APRA released the final version of its revised reporting requirements for residential mortgage lending. It comes into effect from March, and lenders will have to report more fully, including data on gross income, excluding superannuation contributions, new reporting on self-managed superannuation funds, and non-residents, as well as family trusts holding residential mortgages. Reporting of refinance loans should include the data of the refinance, not the original funding date, and APRA says that the original purpose of the loan, whatever it was, is not relevant to reporting when refinanced. So once again, we see APRA in catch-up mode, trying to get the data to manage the mortgage lending sector more effectively. We think they have been too late to the party and still have much to do. The chairman of the Australian Competition and Consumer Commission has revealed that there will be some surprises in the upcoming draft report into how banks price residential mortgage products. The inquiry into how the major banks price their mortgage is the first undertaking of the ACCC's new Financial Sector Competition Unit, which is tasked with undertaking regular inquiries into specific competition issues across the financial sector. Starting with a $1.2 million inquiry into residential mortgage product pricing, the ACCC is aiming to understand how the banks affected by the major bank levy explain any changes or proposed changes to fees, charges, or interest rates in relation to residential mortgage products. The inquiry relates to price changes up until the 30th of June 2018, and a draft report will be published in February or March. This will be an important piece of work, especially as the corporate watchdog has also previously warned that the big banks could be in breach of the ASIC Act over the reasons given for hiking interest rates. Turning to broader economic news, the November data from the ABS shows that Australian retail turnover rose 1.2% in November 2017 in seasonally adjusted terms, and with Black Friday and Phone 10 sales driving the outcome. Now, some will spruik this as a positive sign. However, the more reliable trend data are less positive, with the estimation for retail turnover up just 0.1% in November, which is the same as October. Now, this makes 1.7% over the past year, so is still weak and reflects stagnant wage growth, rising costs, and high levels of debt amongst households. The state trend data showed New South Wales, ACT and Queensland had no change at all. NT fell 0.2%, along with Western Australia, while Victoria rose 0.3% and South Australia 0.4%, and Tasmania rose 0.2%. Online retailing turnover recorded a record 5.5% of all turnover. But the key takeaway is this: households are continuing to keep their wallets firmly in their pockets. The latest ANZ job ads series for December in season-adjusted terms fell 2.3%, largely unwinding the increase over the past 2 months. On an annual basis, job ads were up 11.4%, a slight moderation from the 12% year-on-year growth from the previous month. The labour market in 2017 was characterised by widespread job growth, particularly in full-time jobs, an increase in participation, and a fall in the unemployment rate to a 4-year low of 5.4%, ANZ said. Growth in the ANZ Job Index may provide a leading signal of strong economic performance, but of course this is not being converted into rising wages so far. The building approvals data from the ABS was much stronger than expected, with the number of dwellings approved up 0.9% in November 2017 in trend terms, and it's risen for 10 months. The strong results were driven by renewed strength in approvals for apartments. Approvals for private sector houses fell 0.1% in November. Private sector house approvals fell in Western Australia, down 3.3%, New South Wales 0.8%, and Queensland 0.4%, but rose in South Australia 1.3% and Victoria 1.1%. Consumer confidence was stronger in the first week of January, according to the ANZ Roy Morgan Index, which jumped 4.7% to 122 last week, leaving it at the highest level since the late 2013. It often jumps after Christmas, and perhaps the holidays and the Ashes victory are colouring perspectives. Certainly, it makes an interesting contrast to our own Household Financial Security Confidence Index, which we released this week based on December 2017 survey data. The latest edition of the DFA Household Financial Security Confidence Index fell from 96.1 last month to 95.7 this time, and it remains below the neutral measure of 100. You can watch our video where we discuss this research in detail. Analysis of households by their property owning status reveals that property investors are in particular turning sour, as flat net rental incomes and rising net interest rates hit many at a time when property capital growth is stalling. Owner-occupied households are faring a little better, thanks to a range of ultra-cheap mortgage rates on offer at the moment, but they're also concerned about price momentum. But those without property interests remain the least confident of all, as the costs of renting outstrip income growth and more are slipping into rental stress. More questions came out this week when the ABC reported that a Treasury FOI request has shown that federal Labor's negative gearing overhaul would likely only have a small impact on home values, official documents revealed, which contradicts government claims that the policy would smash Australia's housing market. The previously confidential advice to Treasurer Scott Morrison from his own department said that the opposition plan might cause some downward pressure and that it could have a relatively modest downward impact on prices. This is further evidence that tackling negative gearing should be a strategic priority to help bring our housing market back to reality. There is also a blind spot at the heart of macroeconomics, according to Claudio Borro, head of the BIS Monetary and Economic Department. The BIS is the central banker's banker. He argues that a core assumption implicit in policy setting is that macroeconomics can treat the economy as if it produced a single good through a single firm. The net effect of this assumption is to drag down interest rates and productivity. The truth, he says, is much more complex, and within the economy there are zombie firms where resources are effectively misallocated, leading to reduced productivity and lower than expected economic outcomes, which will cast a long shadow through the economic cycle. The bottom line is, first, credit booms tend to undermine productivity growth as they occur, and second, the subsequent impact of the labour reallocations that occur during a financial boom is much larger if a banking crisis follows. This may also help to explain the current gap between employment and wages growth. Finally, if you want more evidence of the risks in the system, look at the RBA chart pack, which was released this week. You can watch our video on this, but first, relative to the ultra-low cash rate, actual mortgage rates are rising. No surprise given the rise in mortgage stress that we are monitoring. Next, home loan approvals are on the slide. Expect more of this as tighter underwriting standards bite, and many interest-only borrowers are forced to switch to higher cost interest and principal loans. Home price indices are trending lower, but they're still net positive at the moment, but expect more falls in the months ahead. Household debt continues higher, now double disposable income, and we have some of the most highly in-debt households in the world. Lending growth is still 3 times income, so this is likely to continue higher. All this is bearing down on household consumption as real income growth stalls. The savings ratio is falling as households tap into their savings to prop up their finances, which is okay in the short term, but unsustainable longer term. So in summary, UNSW's Professor Richard Holden wrote that troubling borrowing and lending markers in the Australian housing market suggest that the lessons from the US mortgage meltdown have not been learned here. He rightly draws comparisons with the US, as we discussed in last week's Property Imperative, with loose lending standards, a high penetration of interest-only loans, many of which will need to be refinanced to higher rate and principal interest loans down the track, and lie loans. Plus, there are questions about where borrowers are getting their deposits from, even drawing from credit cards or borrowing from the bank of mum and dad. And while more loans are originated via brokers, he suggests the banks are myopic to the risks in their portfolio. He says, we are still left with highly indebted households who have nearly $2 of debt for every $1 of GDP, a raft of interest-only loans that will soon involve principal repayments, and stagnant wage growth, and concludes, having lived in the US during the mortgage meltdown, I'm sorry to say that I've seen this movie before. The question is, why haven't our bankers, and I would add, we think our regulators should answer the same question. We are on the brink, and the game is up. And that's the Property Imperative Weekly to the 13th of January 2018. If you found this useful, do leave a post, add a comment, or subscribe to receive future updates. In the past week, our YouTube channel followers have grown by 1/3, so thanks to all those who joined, and the comments you've left. We're busy collecting questions for our next Q&A session, so keep a lookout for that. Meantime, we'll be back with more insights in the next few days, and many thanks for taking the time to watch.